Hello, everyone. Jeffrey Nance here. Welcome to another edition of Tip Tuesday. We started a series a few weeks ago talking about springing into action. We're going to continue that series today. We've talked about our why. Last week, we talked about what, the importance of having a watch list, something that you can go to and find stocks that are in patterns that are predictable, repeatable, and reliable. Ideally, particularly if you're trading options or spreads, you would have that narrowed down based on the option prices, the difference between the bid and the ask there is when it comes to the spread, so that you really do have a working list that is usable. So that's going to be an important part of that. Today, we're going to talk about a different element. So today, we're going to be talking about when. And then next week, we'll be talking about where. So we'll be actually going in and looking at probably 3 different brokerage opportunities, just so you can get a feel of what those look like, and then how to actually navigate through a broker. But today, we're going to be talking about when. And when is all about timing. So it's WHEN. So let's just say that we know our why. We know why we're doing this. We know why we're trading. We know what our goals are. And then we do have a working list. How do we determine when we should get into trades? So at Tradeway, we teach a 3-leg trading table. So we're talking about fundamentals, technicals, and market tone. And then ultimately, those things would come together to give us an indication as to what a particular stock might be doing at a particular time. And then obviously, that's where the timing comes in. Now, timing is an important element of trading because it can make a huge difference between whether or not you're going to make a little bit on a move in a certain direction, or you could make a lot on a move in a certain direction. And then it can also determine whether or not you end up having an expense, and whether that expense is small or whether that expense turns into a much bigger one than you would prefer to have had on that particular trade. So timing is important. In fact, timing is the main thing that really separates people that I would say are active traders from those that would probably deem themselves to be passive traders. A passive trader would have essentially a buy and hold mindset, with the idea being, well, you can't really time the market. So you can't really know when it's going to go up or down. And because I can't know those things, then I'm simply just going to buy and hold. And in general, the market will go up more than it goes down. And then at some point in the future, when it reaches some random number or something like that, then I'll determine that, it's time to sell. Well, for those of us that are active traders, though, we know that that is a false statement, that we can, within reason, time the market. So therefore, timing becomes an important part of trading. When should I buy? Is it near support? Is it near resistance? Should I sell? So timing becomes an important factor. Timing is not just simply about just kind of knowing, well, what day of the week is it, or where, is it in general in its pattern. It's also about understanding how does that fit into the overall market mentality. So right now, here we are on April 26th of 2022. We are in a very volatile market. So the market is doing some things where it's kind of like, okay, that makes sense. And then all of a sudden you look up and you're like, that makes little sense. And so it can be difficult. If you think of it as a little bit like a dance, it's like, hey, I'm a really good slow dancer, but if they come up and they start doing line dancing, I'm just going to go find a seat right over here because that's not my thing. So you kind of have to know when it comes to timing, just where you feel comfortable entering it, and the types of markets where you say, yeah, I would be totally fine trading this market. I'm going to go ahead and I'm going to share a screen here with you just so you guys can see a little bit of how much the market really is moving and what that looks like. And you can kind of see it when I show you this slide here, which is basically going to be the S&P. You're going to see some really massive swings in the last few days. Well, when you see these really massive swings, what it needs to indicate to you is that I need to be very cautious of what I'm trading and understand what that looks like so that I can make informed decisions, but also at the right times. Okay. So as we kind of go through this stuff, you'll see here that we're going to go over here to, this is charts by trade. We were going to go over here to the chart and we're going to type in SPX. I already have it here. And what you'll find is just really lots of movement. We're going to zoom in here a little bit tighter here because all we really need to see is what's happening right over here in this area right here. Guys, this is where we are today. And so when you start to look at these candlesticks, we had a market that was relatively kind of just floating in a fairly tight range for about a week. Then it got above the moving averages. So now you're thinking, okay, well then I guess it's going to go up, and that would have been a good way of thinking through that. And then all of a sudden, talk about timing. This is a really kind of unexpected turn. Now it could have been due to some news about, interest rates, et cetera. Regardless of the reason why, the market turned significantly. It moved substantially and went from not only being not bullish to a really strong move down, back down into this same area. And then on Friday of last week, it opened and then just dropped and dropped and dropped and dropped. Now it was dropping again yesterday till it hit a low down here, which doesn't make a lot of sense. It didn't make a lot of sense yesterday why it turned there. It still doesn't today. But it turned and then it ended up positive. And then you see this move down today. We opened lower and then we fell a lot today. It ends up being down over 120 points and still has a little bit more where it could fall here. So we'll see if we're actually getting close to support. So I want to talk to you a little bit about this. You can see this area right here. You can see there's 2 wicks right there in that range, right there, somewhere between around 4160-ish area. So right around that, could be a little bit higher, a little bit lower, right around 4160, somewhere between 4150, 4160. Kind of looking at that area as support and saying, okay, so if the S&P does drop down there, a lot of stocks are going to be nearing an area of support, particularly after a big move down like we saw today. So when it comes to timing, you say, okay, what if the overall market does turn tomorrow? What if it starts to make one of these moves back up? Would that make sense? And based on the chart, and we would say, yes, the timing of that move would make sense. If we drop down here to around 4160 after a big sell-off today, and really 2 big days of selling off, it was going to be a third here till it flipped. I really wish these candlesticks had been reversed. That would be incredible, but it's not the way it played out. That would have been nice if we would have seen this candlestick yesterday hit that 4160 area and then we saw that. That would have set up very differently. I kind of wish we had seen that. That would have been really nice. That would have been a very recognizable pattern. That would have been sweet, but that's unfortunately not what we got. And that does make the timing a little bit harder. So ideally, we would be looking to align our entries on our individual stocks with something that aligned with what we thought the market was going to do. So in other words, we're trying to go with the flow. And so when you look at certain opportunities, you say, all right, so I'm going to start with market tone, but then what do I do and how do I know whether I should get in a trade? Well, let's look at Alcoa here. So Alcoa has been dropping, but then you can see yesterday when the market turned, it tried to go up. In fact, Alcoa tried to go up today too. At one point, it was in the green. Now, if the market had been positive and Alcoa had continued to try to go up, that would have made a lot of sense. In fact, it could be trying to do that, even tomorrow or maybe into the latter part of this week. Because it's trying to go up, right? And this pattern indicates that it's ready to move up. It just needs something besides negative market tone. So when you start to think about timing, it involves the market tone. That's a big key here. But also we have to look at our individual stock and say, is my individual stock representing that it is at a pivot point? Remember, a pivot is where we're turning direction. Okay, so we were going this way. Now we're going the opposite way. That's what we're looking for. That's how we're trying to determine our timing, is when the market turns. And then we have this one, Blackberry. Now we talked about Blackberry. If you go back a day here, watch this. You would say, well, Geoffrey, that looks very different. Well, it did. Okay, so Blackberry was falling, but you can see here that it was entering an area of support, right like it was right here. See that? See how it was falling, but then it hit this area of support? Well, here we were again, right in this same area of support. Now, if the market had been more positive today, I suspect Blackberry would have moved up at least to the 5-day, perhaps even higher. In fact, that's what I was anticipating. However, with the extreme negativity of the market, not only did Blackberry not move up, it didn't go sideways, it dropped, guys. Why? It succumbed to the market tone. And so when you think about timing, you say, man, Geoffrey, I've got this play lined up. It looks terrific. All I need is positive market tone. If I get positive market tone again tomorrow, Blackberry is going to move right on up and it's going to be so great. Could have been. Okay. It could have been. What might have been is kind of what we talk about here. What might have been. And indeed, you were right. Okay. The timing was there if we had positive market tone, but this is a case of needing all 3 legs of the trading table. So even though the timing looked right, the negativity and the overwhelming negativity of the market tone is what hindered this play, which would have caused us, or hopefully created an atmosphere where we would have said, you know what? Let me stop out. So if I got into this trade yesterday, I would want to stop out today. You say, well, Geoffrey, that's a really quick stop out. Well, remember, we're trying to win big and lose little. We weren't planning on making a lot on this anyway, so we certainly don't want to lose a lot. And there was a possibility where we really could have lost little on this trade. And let's say you were going to make 30 or 40 cents, but you only lost 10. Well, if you're making 30 cents a trade and you're only losing 10 cents when it moves against you, you can see that over time the math would really work in your favor. So even if you only got maybe half your trades where you got them directionally correct, where you thought it was going to move up and it did, let's just say you got 2 where you made 30 cents and you had 2 where you lost 10. Well, you're up 60 cents on the 2 that worked. You're down 20 cents on the 2 that didn't. And after essentially 4 trades, now you're up 40 cents a share. And you say, well, Geoffrey, that's not going to make me rich. Well, it depends on how many shares you have. 40 cents can be quite good. It depends on how many shares you have. All right. So what we want you guys to do is to try to understand that all of these elements work together. And yes, you can feel like, oh, I've got a good setup here, but timing matters. So, if you were thinking about doing this play last night, you look at it today, you go, whoa, slam on the brakes. Okay. The timing is not right. It looked like it was going to be great last night, but when we see the market tone, we realize, whoa, the timing is off. So we want to enter our trades when we feel like the momentum of the market is carrying us and our stock is creating a pivot here. That pivot could be a wick. It could be a candlestick like this where we see a small body, but it turns, because we could anticipate something like this happening if we receive positive market tone. Unfortunately, we did not get that today. So a good stop out was in order. If you entered Blackberry yesterday to stop out today, why? It tried to work. You thought it was right. You were at support. There were things lined up. You just needed positive market tone. You didn't get it. And not only did you not get positive market tone, but you got very negative market tone. Your stock just couldn't hold up with the depth and breadth of the fall today. And so we had an expense. So when it comes to timing, when it comes to the win, remember, guys, in order to get the WI in, it really helps to know when you have the WHE in. All right. So the timing helps us get the WI in. So timing is important, and we want you guys to understand more and more about timing, how that works for you, and how you can get better at understanding what the market's doing and how you can time your entry and your exit on your trades. Well, that's it for today, guys. Thanks for being a part of another Tip Tuesday, and we'll see you guys next week.